Good morning, teacher. This is our group assignment, and the group assignment topic is the impact of U.S. market economy on shock returns of General Motors during the COVID-19 period based on CAPM and ARDL model. There are our group members. And the first one, I want to introduce the study. The outbreak of the lung disease virus has affected the world economy, and all countries will face a sharp decline in national economic growth, which has a profound impact on the global economy. The most obvious effect has been a market reduction in global travel and trade, which has caused a severe trauma to countries dependent on tourism and international trade. Secondly, many countries and regions have implemented home-based lockdown measures, caused countless business to suspect business, affecting the employment and income of most people. In addition, the pandemic has accelerated the online transformation, focusing many business and individuals to adapt to new ways of working and living. Finally, it has led to disruption in global supply chains, affecting various industries, especially manufacturing and retail. Taken as a whole, the COVID-19 pandemic has had a long-lasting and complex impact on the global economy. For auto giants like General Motors, the pandemic has particularly affected the production line options and the global scales. This has also promoted companies such as GM to pay more attention to the research and development of electric vehicles and automotive driving technology, accelerating the transition to further automotive technology. Therefore, it is very necessary for this paper to study the relationship between the expected return rates of GM's assets and the system risk. The study of this company has great significance and far-reaching influence on the research of the whole marketing. In this study, by constructing CAPM model for shock market transitions, the relationship between asset price and the risk of General Motors is studied, which helps investors calculate the risk premium of investment. At the same time, the model passed the stability test and congregation test and obtained the specific value of the CAPM model. Next, the paper continued to study the ARDL model and estimated the long-term relationship and short-term relationship. The research results showed that whether the risk premium of General Motors at the current time point is affected by the risk premium of the previous two time point and the impact of the risk premium and at the current point of SP 500 index. We found the historical data of the U.S. Treasury bond yield for 3 years from January 1, 2020 to December 31, 2022, the historical data of General Motors, and the historical data of the U.S. Standard Poor's 500 index for these 3 years, conducted in integrated analysis and differential research on these three data, and then import the data into eView software, build and test a series of models.
Okay, let's get into the second part. From the introduction, we can see that our focus is General Motors stock returns during the challenging period of the pandemic. Next, we will using the run-through test and the CAPM model. Look at the scatter plot. We can see two graphs illustrating time series data for LGM and LSANDP. The LGM chart on the left shows a notable increase from the first quarter of 2020, peaking in early 2021 before a slight decline as we moved into 2022. This trend suggests a significant recovery and a subsequent stabilization over the period. It can also be observed from the figure that the two sets of data are not stationary. so a unit root test is required. A unit root test is a statistical method used to determine whether a time series is non-stationary or stationary. Here we will use three different kinds of tests to do the unit root test. They are the ADF test, PP test, and the KPSS test. The following we will show the results. Firstly, we can see the ADF test result. The ADF test is a widely used test and valid in large samples. From the result, the variable LGM and LSANDP indicate non-stationary in their levels, as their p-value are above the 0.05 threshold, failing to reject the null hypothesis of a unit root. Conversely, the first difference data rejecting the null hypothesis and confirming stationary. This pattern of non-stationary at level and stationary at first difference indicates that both series are integrated of I1, requiring one differencing to achieve stationary. Let's see the PP test results. The PP test is similar to ADF test, and we can get the similar results. So the results is strengthened by PP test results. However, the third KPSS test, unlike the ADF and the PP tests, the null hypothesis for the KPSS test is that the series is trend stationary. From the output, KPSS test results of LGM and the LSANDP time series data show that both of which are higher than the critical value of the intercept, indicating non-stationary. However, after the first difference, the statistic falls below the critical threshold, indicating that the difference series is smooth. Now we can compare the results of the three unit root tests. We can get the same conclusion. Each test confirms that the series originally non-stationary. After differencing, the ADF and PP test points out the necessity of differencing to achieve stationary. The KPSS test under its stationary hypothesis agrees as evidenced by lower post-difference test statistics. The unified results from ADF, PP, and KPSS indicate that LGM and LSANDP are first difference stationary, I1. This suggests that while the undifferenced series may trend, their differences do not, making them suitable for econometry. To this slide, we observe the difference time series for RGM and RSANDP. After applying differencing, we see a stationary pattern emerge in both series, which is essential for our analysis. By transforming our data in this way, we are better equipped to apply statistical models that assume stationary, such as the CAPM model, which will be our next step in the analysis. Next, we dived into the CAPM model. This model helped us dissect the risk-return dynamics of GM stock. Particularly, we evaluated how GM's stock returns responded to fluctuations in the market, providing insights into its risk sensitivity during the pandemic. Then we can get the regression result shows a solid positive link between the General Motors stock axis returns and the SP 500 axis returns. The CAPM framework is created. About 50% of variation in General Motors axis returns is accounted by the model, with the market's axis returns being a significant factor. The analysis applies CAPM to show how market performance can explain individual stock returns. This slide shows beta coefficient hypothesis test. We do two hypothesis tests. The first one is beta equals 0. The null hypothesis and the alternative hypothesis, and we will calculate the t-statistic. The diff is more than 120 from the t-test table, so the beta coefficient statistically is significant at the 5% significance. And the second hypothesis test is the null hypothesis is beta is less than 1, and the alternative hypothesis is beta is greater than 1. From the t-table, we can also calculate the t-statistic, and we can get the result is we will reject the null hypothesis. So there is sufficient evidence that the 0.05 level to show that the General Motors security has greater risk than the market.
From the results of ARDR model, we can get the equation. The dependent variable ERGM represents GM's risk premium, and the ERGM -1 and ERGM -2 being the hysteresis of the dependent variables, which is the value of ERGM in the previous and two periods. Such from the equation, the hysteresis coefficients of those are 0.029506 and -0.049399 respectively. The independent variable is the risk premium of the Standard and Poor's 500. The coefficient is 0.23266, which is its impact on GM's risk premium, and the intercept is 0.342483. We can see from the table that the value of Bond's F-test is 616.911, which is much larger than I1 at the criteria values at 1%, and similarly greater than I1 and I0 at criteria values at 5% and 10%, implying that the null hypothesis is rejected. So we can note that there is a long-term relationship between the independent variable and ERGM. The p-value of cointag is 0, less than 0.05, so reject the null hypothesis that the firm's risk premium will adjust towards the long-run equilibrium, while a negative coefficient indicates that the firm's risk premium will adjust towards the equilibrium state. And the AIC value of ARDL20 for model 15 is the smallest, which is 4.501492, indicating that the error of this model is the smallest.
There are three residual tests. The first test is LM test. The LM test new hypothesis is the absence of a particular partner or property in the residual structure. The alternative hypothesis indicates that this partner or characteristic exercise for the residues. This is the result. According to the result in the LM test, the chain square test has a p-value of 0.5185, which greater than 0.05. So the new hypothesis is not rejected, which means that there is no particular partner in the residual structure. The second test is the heteroscedasticity test. The heteroscedasticity test new hypothesis is the residual variance is constant. The alternative hypothesis is the residual variance is not constant, and there is a heteroscedasticity. The white test was chosen in the heteroscedasticity test. According to the result, the significance level of 0 was obtained, so rejected the new hypothesis, implying that there was a heteroscedasticity and the residual variance was not constant. However, after trying to correct for heteroscedasticity, there is no change in the final variance test result and the modified ERDL model. The final test is a normality test. The normality test new hypothesis is the residues are normally distributed. The alternative hypothesis is the residues are not normally distributed. The result is shown in the picture. In the normality test, the p-value is less than 0.05 because the result is 0, so rejected the new hypothesis, indicating that the residuals do not conform to the normal distribution. That is, there are some abnormal factors such as nonlinear relationships and outliers are not captured by the model. In conclusion, first, there is a certain relationship between the stock return of GM and the market return. Second, GM's systemic risk has been somewhat affected by the epidemic. Third, GM stock returns during the COVID-19 period were stable in the long run and were not greatly affected by the market. Finally, in the short term, GM stock returns are still affected by short-term market fluctuations and are slightly up and down. Okay, this is our report. Thank you for listening.